Today we are going to learn about the 10 best chart patterns, and I will show you how to trade the best chart patterns in the Ultimate Chart Pattern tutorial. But before we get into the first chart pattern, I want to address the question of why even bother looking at chart patterns, and why should you study patterns, and why will they completely change the way you understand charts. And what gave me a lot of aha moments in my trading is to look at chart patterns as connectors and as transitions. For example, when we take a look at continuation patterns in this video, we will see that a continuation pattern connects the same impulse trend waves. So for example, in case of an uptrend, we are starting with an impulsive bullish wave, then we are seeing our continuation connectors, and continuation patterns, as we're going to see, are, for example, cup and handles, even head and shoulders can be continuations, and also the classic flag or triangle. And continuation patterns exist within a trend context. And the best way to trade a trend continuation is to identify the existing trend direction after the first impulse wave. Then typically you will see one of those common trend connector chart patterns. And then once the transition happens between the sideways correction, the pause in the market, and then the continuation in the next impulse wave, that's really where you want to look for trend opportunities, because you want to avoid the sideways periods, because obviously the market doesn't move as much in those periods, but you want to catch the transition between the correction phase, the sideways period, and the new trend wave, because this is where you're going to find the best trading opportunities, because you're going with the momentum. But also in the case of the trend reversals, trend reversal patterns, as we will see, can be wedges, they can be head and shoulders, inverse head and shoulders, double and triple bottoms, and a few others, as we will see. And the great thing about trend reversals and looking for those connectors is that those patterns, they connect the uptrend with a new downtrend. And if you are able to correctly identify the reversal connectors, the reversal chart patterns, you are often able to trade new trends very early on with the best possible reward to risk ratio. And looking at chart patterns as those connector types and those transitions can really make a huge difference, because it shows you that you have to avoid trading in the sideways periods because there's not a lot of money to be made. But being able to correctly identifying them, reading them, and then trading them often gives you the best trading opportunities, because then you're going with the momentum and you are very early on in the next trending phase. Let's start with the first pattern, and let's start with the cup and handle. And the cup and handle is often overlooked, but I think it's a great pattern to study because it's a complex pattern. It often comes up. It's also timeless and universal, so no matter what time frame you are on, whether you trade the 1 minute or all the way up to the weekly or the monthly, you will see this pattern. The cup and handle is traditionally classified as a trend continuation. And what is great about the complex cup and handle is that you also have other components such as the breakout buildup and the pressure pattern. And this is how a cup and handle looks like. You typically obviously look for them in a trending context. So you want to see a strong impulsive phase. In this case, we have a strong impulsive bullish phase. Then for the cup and handle, you want to see a clear horizontal flat support and resistance level. A horizontal level is usually preferred when it comes to pattern trading because it's more objective. Then what you often see is within a cup and handle is that you have order absorption around the level, which means that each time the market comes away, goes into the level and then pulls away, it comes back sooner and sooner. So we can compare the distance between this high and this high, this high and this high. So you can see each time the market spends less time away from the level. And this shows you the absorption of the buying and the selling pressure. When the market comes back to the level sooner and sooner, it shows you that there's a lot of buying pressure building, that there's a lot of bullishness in the market. At the same time, when we look at the lows, you can see here we have equal lows, and then suddenly here, this is the pressure pattern, this is the breakout buildup, you have a significantly higher low. This shows you that whereas in the past the market was able to pull away from the level, this time this was not the case, and the market, after touching the resistance and moving away, the price was immediately pushed back into the level. This is a very, very bullish signal. And taken together with the other bullish signals, the market being in a strong uptrend, then also the component of order absorption and the pressure buildup, those are great bullish criteria to look for in a trending market. Then you typically either approach those types of patterns with a breakout entry, or other traders will also often choose a pullback approach. Also, if you watched my latest videos about the liquidity run and the dirty pullback, you often see deep squeezes, not always, but some of the time. Typically, when you get into a breakout, your stop zone is clearly, obviously, underneath the resistance area in this case. And then some traders who play it safer put their stop loss all the way above the low. Other traders, if they are more aggressive, they may choose to have a much tighter stop loss, which then will boost your reward to risk ratio. But of course, you will risk the market taking out your stop much faster. And then you can see the market rolls over into the next trending leg. So here we can clearly see it. The cup and handle is a continuation pattern. It connects the first impulsive trend wave, the first impulsive bullish wave here, with the next impulsive bullish wave. You clearly want to avoid trading in the sideways phase, but you want to catch the transition between the correction sideways and the next impulsive wave. The next pattern is a fake out or a trap. It's a trend reversal. It's more of an advanced pattern, and there are a lot of things coming together here for the fake out and the trap. I really like those patterns. I think they are really interesting to study, and often they lead to very fast moving and accelerating price reactions. So as I've said, when we talk about trend reversals, you want to make sure that you are looking for a trend reversal in a quite mature trending environment. So here we can clearly see that the market has gone up for an extended period of time, and then we roll over into a long sideways phase. This is also what we would call a distribution. A distribution is a transition where the people who have previously bought up and are sitting on profits are now unwinding their positions. They are getting out of their longs, and probably also because the price is so high, more and more sellers are interested. Then what you see is here the fake out. The market makes a run above the previous highs, but within one or two candles, typically you want to see a very fast rejection of the breakout. You're back within the pattern, you're back in a sideways range. What is also really interesting is about those fake outs is the reaction and the volatility. You can see here, whereas after the market hit this high, the candles are very small. There's not a lot of momentum and also no volatility. But around the fake out area, you see an increase in candle sizes. The candles are suddenly getting really large, which is often an indication that there's a lot of unwinding going on, new positions, a lot of exit taking, a lot of uncertainty. You definitely don't want to trade a fake out as long as the market is still in the distribution. You have to make sure we are clearing the lows first. You don't want to get caught up in this volatility. When you get, or if you would choose to trade such patterns inside of the range, your stop loss will probably get hit quite a bit, and there's so much uncertainty. Often you will also see an increase in spread because there's so much uncertainty in the market. So you definitely want to make sure you wait for the market to clear the lows. Very often, when you see a pattern with a high volatility level, you will also see a very quick and strong release. So the large breakout candle is a really great add-on for this type of pattern. It shows you that the bears are really taken over, the bulls have absolutely no control over this market anymore, and the power is being released here with this huge breakout candle. Then the new trend rolls over. So what we see is a very strong impulsive phase, a mature trend, then we have the distribution, and we roll over into the new downtrend. So the fake out pattern is a connector and a transition between an uptrend and a downtrend, as we've learned in the beginning. Next, let's talk about congenations, which I think are a really great starting place for maybe your first pattern. If you want to look for a continuation pattern, I think flags are a good starting point. They're also very universal and timeless. So whether you look at charts from today, 2023, whether you're watching this video in 2025, or if you're looking at historical charts from the 1980s or 70s, you will see flag continuation patterns. And they are obviously continuations. So what we have is a trending context. You want to first see the market in a strong bearish trending impulsive wave. Then you want to look for the flag. The flag looks like a channel. So you often have parallel trend lines in the flag. Here, when we connect the highs, we get a trend line. When we connect the lows, you get a trend line. And often, not always, they are parallel. So this resembles a flag. In this case, obviously, a flag upside down. But if you would look for this in an uptrend where you have the uptrend and then the flag to the downside, then it would look like a regular flag. And what is really interesting is looking at the strength of the trend waves. In the beginning, in the impulsive trending phase, the market fell in a short amount of time quite a bit. So the incline, or the decline in this case, is very strong. A lot of selling power here. And here, the market tried to rise, tried to make a run, but the correction, the bullishness is very weak. So this shows us overall that in total, there's probably more selling behind the scenes going on, and the buyers are not really interested in getting the market going. So not a lot of buyers here. So we have a strong imbalance and a lot more sellers than buyers. What is really interesting to do in the context of a continuation is that you can perfectly combine it with other indicators. For example, you could use a 50 SMA. You could also obviously use other period moving averages, but also what you will often see is a flag happening into a central daily or weekly pivot point. Really great indicators as well for this type of trading. And what I would recommend in the beginning to start using one of those indicators, see which one makes sense to you. Maybe you've used one in the past that you know about. I would add this to this type of continuation trading, because you will often see that the price runs into those types of indicators, finds resistance, and then turns around. In this case, again, we have a breakout candle, a very strong breakout candle, which is quite typical. You will often see breakout candles that are quite large. A lot of momentum is being released. The bullish side is withdrawing here from the market, and then you can see the market rolls over into the next impulsive wave. Before we continue with the video, I want to show you my new trading program. I call it the Tracademy. And this is the ultimate all-in-one trading education program. What you will find here is a completely new trading course. I've recorded over 80 videos with brand new trading content. The videos in this trading course have never been shared anywhere else before, and I go way deeper than in all of my YouTube videos. Also, you get mentored directly by me. I'm not using other teachers, I'm not using other coaches, I'm the one that you're always interacting with. There are live webinars taking place almost every week, and there's also a private community with other traders from all around the world, and also me. I'm interacting with all of my traders in the Tracademy directly and personally. So you join the new video course, you get personally mentored by me, you have new trading strategies. They are completely brand new strategies. I've never shared the videos before. They are for swing trading, day trading, and for all the time frames. There's a great and supportive community. It works for Forex, commodities, cryptos, and also indices. Everything that I've learned mentoring traders for the last 8 years and having been trading myself for over 15 years is included in this course. There's also a certification program. So after you've gone through the course and you have learned the material, there are 60 trading questions waiting for you where you can prove your knowledge and then at the end get certified. So if you're interested, make sure to check the video link in the description below. If you have any questions, leave a comment. And if you decide to enroll, I look forward to welcoming you in the Tracademy. Now let's take a look at the wedge. The wedge is a trend reversal pattern. It shows you the component of momentum fading. So you have an existing trend that is losing strength, and we're using trend lines for this pattern. So what we see here is a downtrend. And what we want to see when we trade reversals is you want to typically look for a reversal pattern in a mature trend, which means that the trend has been going on for an extended period of time. The longer the trend has been going on, and when you then see a trend reversal pattern, an exhaustion pattern, the better it is. The longer a trend has been going on, the higher the chances of seeing a good and strong reversal. Why is that so? Also because of the fact of taking profits. So the traders who shorted this market, when the market has gone down quite a lot, they are obviously having more unrealized profits. And then they are more likely to take profits. And when you see a lot of profit taking in a downtrend, this means a lot of buying activity. And that's why the transition in a mature trending phase can sometimes lead to very quick, very strong reversal patterns. But what we see here is also quite interesting. We clearly see the market is still making lower highs. LH stands for lower highs. And then when we look at the bottom side of the wedge, we can see that although the market is making lower lows, there's a lot of weakness in the lows. What does it mean? It means that the trend line to the downside has a much lower and less steep angle as the trend line to the top. So the market is not able to push lower as much as it used to. Here you can see there's a huge decline in the price. Here, not so much. The price was not able to move lower a lot, which indicates that there is less and less selling interest. If you would put a MACD or an RSI or even a stochastic here, you would see that those indicators will give you a momentum divergence. Then what I would recommend, because trading trend lines is a little bit more subjective because trend lines can be drawn in so many ways, I would recommend identify the last swing point. Swing points are typically touches of the resistance area and of the trend line. So what you want to do is wait for the market to break the lower high structure, and then we are making a higher high. This is very important. A higher high structure change shows you that the overall sentiment in the market is changing. The market was never able to make a higher high in the downtrend before. This is changing here. After this weak low, almost a double bottom, and then you can see you have the strong breakout. Stop zone typically underneath the breakout sequence. So here's the last low. It's also some type of pressure pattern. And then we have a very clear breakout entry. And then you can see the release of the bullishness is very, very strong. This is or could be a factor or due to the extended downtrend here. A lot of traders are probably sitting on a lot of unrealized profits. And then once they see and realize that the market is turning, a lot of them are going to run for the door, go for the exit, take profits, which then contributes to this very strong release of buying power. So that's why it's really interesting to focus and study those types of reversals. Next, let's take a look at the head and shoulders. I love head and shoulders. If you look at the classic trading books, head and shoulders are often classified as very high probability, and they are really great because they happen all the time. They are reversal patterns. It's also a really great pattern for a starter. If you're looking for a starter pattern when you look at a trend reversal, head and shoulders are really great. What we see here is a mature uptrend. Then we have the head and shoulders here. The head and shoulders has on the left side higher highs as indicated here. And then from the head, the highest point, afterwards the market fails to make a higher high. And then this next swing point, this is what we will call a right shoulder. Again, you can also see how long this is taking. The market is spending a lot of time moving sideways, not being able to continue above the highs. So again, we would call this a distribution, an extended sideways period. Now we would just wait for the market to clear the lows. In the case of head and shoulder, we would call this a neckline. So you can really nicely see why this is called a head and shoulder. Left shoulder, then the head, we still make a higher high. And then we have the right shoulder on the right side, obviously. Then we again wait for the breakout candle. Very strong breakout here, a great indication and a classifier for the pattern. And then we start a new downtrend. What we see here is a trend continuation pattern, but I will come back to this in a moment. And we can already see that this kind of looks like a head and shoulders again, right? Left shoulder, head, right shoulder. But let's keep going and let's take a look at a head and shoulder as a continuation. So head and shoulders can come in different shapes and in different situations. They can happen in a trend continuation context. So here what we see is that after the market rolled over, here what we have is a fake out, right? Strong liquidity gap, void. The market tried to break out. We are rejected here, or the price is rejected rather, within 2 candles, which is very important in the case of a fake out. You want to see the fake out fail really fast. Then you have the first impulsive trend wave. Where does it end? Right at the liquidity gap void. So you could have traded the fake out here as your first entry opportunity. Target wise, the origin of the liquidity gap or the void would make for a good target. And then we see a head and shoulder as a continuation. Why continuation? Because we are just coming, we have our first downtrending leg, the first bearish impulsive wave. Then we have the first correction, left shoulder, head, right shoulder, especially the sequence here on the right. From the head to the right shoulder, you have significantly lower highs, and this is showing us weakness. Whenever the market cannot continue and fails to make a higher high or a lower low in case of a downtrend, that's weakness. Then we have the continuation breakout, and the next impulsive wave. So you can clearly see the sequence of impulsive wave here, corrective sideways phase, and then this is the transition, and the connector is the head and shoulders pattern between this impulsive wave and this impulsive wave. The next pattern is a 1, 2, 3. I really like this pattern. I would say it's a little bit more advanced, but it's a liquidity pattern. It's a complex pattern, and it can occur both in context of a continuation or a reversal. Let's take a look at it in the context of a reversal. So again, we need to have a mature trend. If you don't have a mature trend, looking for a reversal doesn't make a lot of sense. The probabilities are really low. But what we see here is that the market make higher highs and higher lows, right? I indicated the higher lows here. We have a low here, here also, low, higher low, higher low. And when the market changed this structure, we are breaking structure, we're making a lower low. This is the first sign that something is changing here in the overall market context. At this point, because we don't have much else, I would not recommend to just short the market. So we don't have any of our other reversal patterns. We don't have a head and shoulders. We don't have a wedge. We don't have a double top right now. So we don't have much that we could use for our entry timing. But in the case of a 1, 2, 3 pattern, we are starting to count 1 at the highest point. When the market breaks the low, we make our first lower low. This is the point 2. And then we wait for the market to pull back below the highest point. So we are making a lower high as well. We're not only making a lower low, but we wait for the market to make a lower high, which further confirms the strength in the selling and the weakness in the buying. For example, here, we now have the lower high, we have a lower low, lower high, and then within this area, you would look for a pattern for a breakout. For example, what we could be doing is we go to a lower time frame. What we will see here is some type of head and shoulders as well, double top. Weakness we have here an engulfing candlestick entry, and then very often, not always, you will see the new trend emerge. So you can see there's a lot more going on. It's also not as clear cut. We are not dealing with clear horizontal areas, levels. We don't have clear pattern boundaries. So this is more advanced, but it's really a great study and a great pattern to understand, especially if you're a little bit more advanced. This is something that really can make a difference in your trading because it helps you to understand the rhythm of the market, higher highs and higher low structures. When is such a structure broken? When pull we back? Very often you will also see that the point 3 is happening within a supply and demand area as well here, which can be another great classifier. And then you roll over into the next trending leg. So it's something to really study. There are a lot of different names floating around for the 1, 2, 3 pattern, but 1, 2, 3 is the classic and the initial name. One thing that I would like to point out is that I have a weekly newsletter. It's completely for free, and every Thursday I'm sending out a new email with brand new trading tips. Sometimes it's about chart studies, sometimes there are setups included, sometimes it's about the mental side of trading, or just tips for your trading psychology. It's absolutely for free, and you can sign up on the Tradeciety.com newsletter. There's also a link underneath the video description, and you will hear from me every Thursday. There's also a free ebook coming with the newsletter subscription after you've signed up. But let's get back to the video, and I want to talk about the double top now. Next is the triangle pattern. Triangles can come in many different forms, and I would recommend to focus on a horizontal triangle in the beginning. They are typically trend continuations, and there's also the component of the breakout buildup and the pressure pattern. So what we see, we have an impulsive wave, which means that we are in a bullish trending phase. That's very important. Before the market goes over into any sideways phase, any sideways chart pattern, you want to make sure that you are able to identify a strong trending period before that. That makes sure that you are trading this in or as a bullish connecting phase or bullish connecting chart pattern. So we're coming from a bullish trending market. We put in the resistance area, and then you can see what makes the triangle a triangle is the higher lows. So you can see we have a lower low here, higher low, higher low, higher low. When we connect those lows, you will get this diagonal trend line, which then gives you the form and the shape of the triangle. So we are making higher lows, which indicate there's more and more bullish interest and less bearish interest. Very strong bullish breakout. You typically don't have to wait as long as shown here. You could get into a trade when the market or the price takes out the previous highs. Some traders even go so far as getting into those continuations when the market closes above the recent closes. So they don't use the wicks, but they're looking at the closes, which is typically also done when you have a line chart. Also something to think about. Line charts can be really great tools as well. Then stop zone, again, definitely underneath the resistance, and then how far you put your stop underneath the resistance and the breakout area is a little bit up to you. There's a lot of discretion, and it depends on whether you want to go for a low or high reward to risk ratio and how easy you want to make it for the market to take out your stop. And then you can see we even have a retest entry. So this time the market retests the previous highs. Then we have a continuation. We go over into another triangle. We have the continuation breakout and then the next impulsive wave. So you can clearly see the rhythm of impulsive wave here, then connector, triangle, sideways, then the next impulsive wave here. We go over into a connection here into a sideways chart pattern. The breakout leads then into the next impulsive wave. The double top is typically a trend reversal pattern, and again we look for it in mature trending environments. The double top takes often a longer time to unfold, and those longer sideways periods, as I've mentioned in this video or hinted in this video previously, is that we would call them a distribution pattern. What you will often see is, for example, in a flag or any continuation, flags or continuations in general don't take as long. And the ratio between impulsive and sideways phase is often very clear. The impulsive wave and the sideways phase doesn't take as long. Whereas when we look at reversal patterns, there's usually a different ratio. What you will often see in case of the double top is that the sideways phase is going on and on and on. And the longer a sideways phase is going on, the lower the likelihood that this will turn into a continuation, which is quite an important insight to keep in mind. So we're coming here from a mature uptrend. The market has been trending higher quite a bit, and then the market is rolling over into a long distribution. Also, what we see here is a divergence. From here to here, the market is not making significantly higher highs, nothing compared to before. Here we had a very strong impulsive phase, and then here the next one, much less impulsive. Then also we see weakness, whereas previously the market still tried to achieve and try to make a higher high. Although it was rejected, here we are starting to make lower highs. We're also seeing some more bearishness in the market. Then we have the breakout entry. We are making here a lower low, and then the market moves lower and starts a new downtrend. If you see something like this, this is what we would call a void or a liquidity gap. Although there is no physical gap, there's no empty space on the chart, still we would refer to this as a liquidity gap. What you will see is if you, for example, put a volume profile on this and analyze this area, you will see not a lot of trading activity. Sometimes within those periods, there's almost, or those sharp moves, there's almost no trading activity. And this is why we would refer to this as some type of gap or void. And those are great targets because the market has an often, not always, an easier time to travel through the void. There's not a lot of resistance here on the way down or support. And very often you will see that the market is pulled into the initial breakout, into the initial demand or supply zone in this case. So they can make for great target choices if you're looking for an exit approach. Triple tops are obviously very similar to the double top, just we have one more top. So again, triple top is a trend reversal, just such as is the double top or the double bottom. So we want to see it in a mature uptrend, a long trending period. Then the market is taking a long time to not continue higher. In this case, obviously, we are putting in this very nice resistance. So we have one top, two tops, three tops, triple top. Then we have our clear horizontal level to the downside. Even you could say here on the third top, we have signs such of a head and shoulder, right? We have the left shoulder, the head, and then the significantly lower right shoulder. This is a very, very important market tell. This is a pressure pattern. Whenever you see that the market is not even able to come close to a previous high, whereas in the past it was easily able to push into this level, that clearly shows you that something is changing here behind the scenes. And something is really different here in the market structure. Not a lot of bullishness, nothing compared to what has happened here. In the case of this long distribution, very important. Another thing that we can do is zoom out. Where is this happening? And this is something that you can do with pretty much all patterns. The confluence factor of context. So where is the pattern happening? This is the triple top that we are seeing here. But if we zoom out, we're seeing that this is happening at a previous important turning point. The market turned at this area and started a new downtrend. So clearly, the traders are watching this. Something has happened in the past, and you can be 100% certain that more traders are looking at this market right now just because of the confluence here. Also, we could add other indicators. The moving average, for example, or in this case, we are looking at a weekly traditional central pivot point. You want to see in a downtrend that the market is trading below the pivot. In the uptrend, the market is able to trade above the pivot. Now it's trading below the pivot. So clearly a very important shift. Now we're breaking out. We have the pressure pattern, the breakout entry, stop. In this case, typically you would put it above the moving average, maybe above the high. A little bit up to you, but those are the conventional stop areas. And then you can see the market rolls over into the new downtrading phase. The rounded top is also a very interesting one. The rounded top is also a reversal pattern. We have a very clear horizontal support level. We have the mature uptrend. And when we look at only the highs, what we can see is this gradual shift, right? On the left side, the market made a higher high, higher high, higher high, all the way until here. And then the market started to make lower highs. So we have this gradual change where the market fails to push into a new high. And also previously, it's not only about here, the lower highs are obviously a very important bearish signal, but also you can see that the distance between each high is getting smaller and smaller. That's really important. In a strong uptrend, the market is easily able to push higher. When the market is failing to push higher as easily, that's really, really important. So definitely something to always keep in mind as well. The distance between highs and the distance between lows, very important market tell. We break out here. Here again, we are dealing with a void. Here's even something like a pressure pattern, maybe a cup and handle. You have here the cup, here the handle. This is then the void. So target-wise, this is definitely something that you could use. You can see the market traded into this origin, moved a little bit sideways, eventually continued lower, but it's a great first starting point for looking for targets.